Hello, I'm Steve Lentz with Discover Options and Option View. This is for the Prepared Mind blog. This is the Market Likelihood Report. Welcome. You can go to discoveroptions.com and click on the blog link right at the top there, and that'll take you to Frank Fahey's Prepared Mind blog entry for April 11th. That's, of course, Monday tomorrow. And if you go through that very nice piece, you'll come eventually to an area where he actually will list some candidates for double calendars related to earnings. There's a whole lot of other information there. I'd certainly would encourage you to go take a look at Frank Fahey's The Prepared Mind. So what we like to do here is do a just a market likelihood report, for the Friday's close on April 8th. And here's what it looked like. We had an inside bar, as you can see, and what we're going to do is take a look at this technical setup and then just see kind of what the likelihood is that the market's going to go up, down, or wobble around a little bit. This is the S&P 500, of course, and as you can see here, this is the Metastock code that we use. Friday's high was less than Thursday's high. The low was greater than Thursday's low. That made it an inside bar. And the previous day was a down day where the close was less than the open. All right, so that's the price action piece. We note that the trend is such that the price is above the 65-day simple moving average. And also, in terms of the stochastics telling us an oversold or overbought situation, we were above 40 and underneath 80. So if you look at that specific situation, an inside bar above the 65-day moving average with the stochastic between 40 and 80, kind of like in the, kind of in the overbought range a little bit. But you can see that it's been coming down here. Now, we're not going to address the fact that it's coming down. We're just going to simply state that between 40 and 80. Now, here's the question here. How often since January of 2000 has this same specific scenario occurred, and what did the market do? Okay, if we can go back in the past to January of 2000, and since then we have, basically bullish and bearish markets. So, more time spent in bullish than bearish, certainly, but that's about as good as we're going to get to try and balance those. But if we go back that far and look at all the times that this same setup existed, okay, maybe we can ascertain then what the likelihood is that the market will go up, down, or chop around a bit. All right, and so here's what we do. We like to look at the historical distribution of price since January of 2000. We're going to look at the distribution after this specific setup occurred. And then if we discern that the distribution is different than historical by quite a bit, we might have a tradable edge that exists. Okay, so let's first go and just take a look at, just bring you up to speed as to how we do this. Now, apologies for those of you that have been through this. You can kind of skip to the end if you want. Here's what we do, folks, to do this. We set up volatility bands in 3 time frames, 5, 10, and 15 days in the future. These bands are set 1 standard deviation from the close, and we use 20-day historical volatility that are log normally distributed. So here's an example of our bands. All right, to determine distribution. We have the close, we have the band set above and beneath the close. This is a 1 standard deviation distance from the close using the previous 20 days volatility there. And the question is did the market go up and hit the upper band, go down and hit the lower band, or did it wobble around? And as we can see here, it clearly went up and hit the upper band. So for that particular close, we record that it hit the upper band. Okay, now look at the close there on the right. All right, the question is did the market go up and hit the upper, go down and hit the lower, or wobble around? You can see it clearly wobbled around. It tried to hit the lower band. You see that? There's the lower band. And it came down, but close but no cigar. So in this particular case, it hit neither band, and that's what gets recorded. So for every close, we're going to record how often price struck the upper and lower 5, 10, and 15-day bands. Okay, and we record that as a percentage of the time. And we can see here, look at this, since January of 2000 up through Friday, April 8th, there were about 4,062 signals or so. that is closes. There were closes, over 4,000 closes since January of 2000. Of those 4,000, go to the left there, it hit the upper band from the close. It hit the upper band 29.6% of the time. It hit the upper 10-day band 23% of the time, the 15-day band 23% of the time. Now let's go to the lower bands. It hit the lower 5-day band 29.8, the 10-day band 29.4, and the lower 15-day band 32.3% of the time. So this is the distribution historically. Okay, now we're going to go take a look at this technical scenario and see what this looks like. And if the two are different, if we find that the market does, it leans one way or the other, well, that could translate into a possible edge. So take a look at this. We can go back and see this exact same setup where we're in the stochastics, we're between 40 and 80. We're above the 65-day average. It's an inside bar. And what we can do is go back and record all these instances and determine if from those closes, all right, and even also not only from the closes of that inside bar, but we're going to take a reading if price goes above the high of that inside bar or goes below the low of that inside bar. What's the distribution if it does either of those things? Okay, now before we get to it, I just got to do a little plug here for Discover Options. We have a great continuing education offering for you. If you like this kind of stuff, I'd encourage you to sign up for this 1 year of, for $495, you get a year of inside wires. We give you stock analysis report. Go to the website and check out this list. Call us up, talk to the rep in our office, and we'll be glad to talk to you about what we offer here. But most importantly, of all of these things, see that inside wire? I do a weekly show every Tuesday morning at 11 Central that's live. We archive it. I've been doing it for many years, and we've recorded hundreds of these, well over about 300 to 400 of these weekly sessions now. Each of them has a PDF you can print out of this kind of research. Directional research, non-directional research, volatility research. We review our core strategies from our equities track in our mentoring program. But this is a wonderful way to dip your toe in the water of good, solid options education that's at a pretty high level. All right, so give that a look if you're at all interested in expanding your options education if you haven't already signed up. Okay, we have the historical distribution at the top. And then below that, let me see, I'm going to take my arrow, hopefully you can see it fine. You can see then that at the close of that inside bar, there have been 66 signals, okay, dating back to January of 2000. That's the same setup basically, 66 signals. And of those 66, it hits the upper 5-day band 27% of the time, which is a little bit less than historical. It hits the upper 10-day band 19.7, which is a 3.5% difference. So both of these are a little bit less than historical. It hits the upper 15, roughly the same, just 1.2% more. Now on the downside, okay, it actually will hit the lower 5-day band 2% more often. On the lower 5-day band, 5% more often. And the lower 15, well, about the same. It's about the same. So what we want to know is what happens if it goes up and it penetrates the high of the inside bar and breaks out. What if it breaks out to the upside? Look at this. Little bit of an edge to the upside then. Okay, and so it shows a 1% increase, 2%, 5% on the 15. That's somewhat significant there. Okay, it hits the lower band clearly less often. So it would indicate here that if price penetrates the high of Friday, all right, it's fairly, certainly it's better than a coin toss that this thing is going to, lean on the bullish side for sure. It's hitting the upper bands more often, just by a little, but look at this, it's failing to hit the lower bands by quite a bit here relative to historical. So theoretically, if you're an options trader, you could sell premium down here below the 5, 10, or 15-day bands and have a pretty good an edge there, it would appear. All right, now what if price goes below the low of Friday? Most interesting, look at this. Look at this. It actually, if it penetrates Friday's low, historically it actually hits the upper 10-day band more often. Now there's only 27 times that it did this. Okay, so that, for some of you that may not be enough, but this is just interesting how it actually seems to get more volatile. It hits the upper band more often, and it actually goes down and hits the lower band more often as well. So if it goes below the low, we can look for some more volatility. If you're a condor seller or a butterfly a trader, you may want to be aware that at least the statistics show that it leans a little bit on the greater volatility moving in the future if it penetrates Friday's low. Now, those of you option traders, here's the implied volatility chart in blue. The statistical is in red. Implied volatility is now back to being above statistical. Okay, and in the S&P, it kind of looks like it's getting back to more of its historical norms. Over the last 6 years, clearly implied has been higher than historical, or statistical we call it, by a bit there. Okay, in the recent past, of course, statistical has been really more aggressive than the implied, but it looks like the relationship is getting back here. So in the long run, implied is typically higher than statistical, and here's what we like to do. Instead of using statistical volatility to determine the bands, where the bands are, okay, in the SPX, we can actually use the VIX as a way of helping to figure out where those bands should be relative to what the option traders are predicting. Now, the VIX is typically higher. The option traders typically predict a higher volatility than what actually comes to pass. Make sense? So we're going to take the option traders' predictions and use it to create those bands. And when we do that, we're going to use the SIBO skew symbol to help then adjust the upside volatility versus the downside volatility. So the upper bands will use a lower volatility that you can see down here. The up volatility is lower than the downside volatility. Okay, and when we do that, the bands are farther out, so they get hit less often. And you can see that reflected in these lower numbers, lower levels of historical distribution here. See that? So you can sell premium out there using the VIX as your standard deviation, but adjust for the skew down here. 14.3 on the upside, 16.4 on the downside. Now, most notably, when you look at these farther out VIX bands, adjusted for skew, all right, and then you would expect then that that the market will hit those less often. Okay, so that's why you have lower historical. Now, we see then more red here all across the board. That means that that this setup results in the market not hitting those bands near as often. And you can see here that out of the 66 signals at the close, these numbers are all lower than historical by between 1 to 3% or so. Oh, here's a 7% on the 15. Okay, if it penetrates the high, look at this. It's failing then to hit the upper band by a smidgen. It's failing to hit the lower by quite a bit there. And then if it penetrates the low, okay, it would appear that there's the most notable statistic here is the 15-day. Look at this. If it penetrates Friday's low, it fails to hit the upper 15-day band by short by 11%. meaning that it only hits it about 3.7% of the time, and it also fails to hit the lower band by quite a bit, hitting it only 11% of the time. So that's what we're going to focus in here, is the failure of price over, if it hits the low, if it penetrates the low, to then hit either band. It hits the lower band just 11% of the time, the upper band 3% of the time. So let's look at what a condor might look at using these volatilities down here. 14.3 on the upside, 16.4 on the downside, and here you go. Here's how you might construct a 3-week condor. We plug in 14.3. That gives us an option view, the border of our first standard deviation. And we would put on a credit spread there in the calls. And then for the puts, instead of using 14.3, we're going to instead use 16.4. And that takes us down to a 1 standard deviation level, would be at the 1970 puts. So now we have a skew adjusted 1 standard deviation condor. And when you analyze it, here's what it looks like. Keep in mind that with this setup, theoretically, if it penetrates the low, it's going to go down and hit the lower band right there where we sold premium. It'll hit that band roughly 11% of the time and fail to hit it 89% of the time, meaning that this will expire out pretty nicely. And then this one on the upside, it hits it only 3% of the time, fails to hit it 97% of the time. And so when you run the risk reward analysis here, I think you would agree that there is quite a nice quite a nice edge here. Okay, so that is the likelihood report for this week ending in April 8th. Folks, if you're at all interested in this, as I said, go to discoveroptions.com and check out the continuing education. That'd be a good way for you to get a flavor of what it is we're all about. Trusted and proven, discoveroptions.com. Give us a call at the number below. Thanks so much. Have a great week of trading. Bye-bye.